If countries buy their oil from Venezuela, they have to pay an extra 25% tax to do business with America on top of the taxes they already pay. So, for example, China. In just a few weeks, America's oil sales crashed by a huge 94%, making prices fall really low, stopping drilling, and making energy markets go crazy. Was this Trump's biggest move yet, or the start of America's worst oil mess? On April 2, 2025, President Trump stepped up with a tough move, putting a 25% tax on any country buying oil from Venezuela. The goal was clear: hurt the Maduro government by cutting off one of its last ways to make money. Trump announced this on his Truth Social website. Trump called April 2nd Liberation Day for the U.S. economy, showing a new part of his trade war plan, called Liberation Day for America. On paper, the idea seems simple. By punishing countries that kept helping Venezuela, the U.S. could put more pressure on Caracas without firing a single shot. But what happened next wasn't a clean win. It was like an economic bomb that caught American energy companies in the blast. Countries had kept buying Venezuelan oil, even though the U.S. didn't like it. This move also happened during rising tensions between Washington and Caracas. What people didn't know right away was just how connected global oil markets really are. Even though the taxes were aimed at another oil supplier, the effect was felt right away in America. Traders, bosses, and experts were shocked by how fast prices started dropping. Just announcing the policy made oil prices fall hard. With one move, a political action became an economic wrecking ball. That's because energy markets don't work alone. They're like dominoes lined up across continents. Push one too hard, and the whole line starts to fall down. 25% tax on all imports from countries that buy oil and gas from Venezuela. The move set to start on April 2nd is expected to hit hard. The angry response came quickly. U.S. oil producers, who had been enjoying a pretty stable situation, suddenly found themselves facing serious up-and-down pricing. Plans that had been built expecting smooth sailing and steady sales were thrown into chaos. Many U.S. producers had set up their drilling and investment plans thinking that global trade routes would stay open and predictable. This idea got destroyed overnight. The tax didn't just hit Venezuela. It broke investor confidence, squeezed refining profits, and messed up supply chains that were already under pressure from China, Russia, and OPEC problems. 25% to the United States on any trade they do with our country. In the Post, the president says Venezuela is sending criminals to the U.S., including gang members. By punishing countries that relied on Venezuelan oil, the U.S. accidentally forced them to compete for oil from other suppliers that included American exporters, and that's where the real trouble exploded. With more countries trying to buy non-Venezuelan oil, global price benchmarks went crazy. Prices dropped instead of going up, which meant that American companies couldn't get the prices they needed to make money. Even worse, some buyers just walked away from deals with U.S. suppliers because of pricing uncertainty and future tax risks. What was supposed to be a precise attack on Venezuela ended up hurting U.S. oil's competitive advantage. Venezuela. What's the impact of Venezuela's sales of oil and natural gas to the world? Instead of tightening pressure on Maduro, the taxes loosened the ground under American drillers' feet. Many found themselves stuck with oil they couldn't export at prices that made sense. Storage tanks filled up, ships were delayed at ports, and Wall Street started pulling back on energy stocks. All of this happened in just a few days. One political statement undid years of market gains. And while the White House tried to say the move showed bold leadership, oil companies across Texas, New Mexico, and Louisiana were left figuring out just how much damage had been done and whether the market would get better before it got worse. Reports showed weak trade data for December, hinting at a slowdown in fuel demand. Now, although OPEC-led supply cuts have managed to offer a little support to oil prices, they continue to struggle. The energy sector was already tense when the tax hit, but what happened to crude oil prices afterward felt like a punch in the gut. Almost overnight, West Texas Intermediate, the benchmark for U.S. crude, fell below $60 a barrel. That might not sound terrible to the average person filling up at the gas station, but for energy producers, it was a red alert. It was the first time since April 2021 that WTI dropped that low, and the timing couldn't have been worse. Oil executives had just started planning budgets for the second half of 2025, counting on prices staying steady or going up slightly. That hope disappeared. In a flash, mid-60s, before the end of the year, or otherwise in the mid-70s for short. Wow, okay, so, mid-60s, before the end of the year. Okay, the drop wasn't a slow slide. It was a complete collapse, a 15% fall from highs earlier in the same week. And here's the problem. Most U.S. shale producers need oil to stay between $60 and $65 just to break even. If prices go lower than that, drilling starts to lose money. Every barrel pumped below cost means losing money and tough decisions. Companies either pause production budgets or start hedging like crazy, which only increases their costs in the short run. This isn't just about profit margins. This is about survival. A lot of people forget that modern oil extraction, especially in shale regions like the Permian Basin, isn't cheap. Sure, technology improvements have helped lower costs over the years, but it's still really expensive. Between land leases, drilling, transport, and following regulations, the money adds up. Producers don't just drill when they feel like it. They plan months, even years ahead, and that planning depends heavily on predictable pricing. When WTI slipped under $60, it sent a clear message to producers. The numbers no longer make sense. Expansion plans were paused, new projects shelved, and some companies began laying off workers before losses got worse. There was a decline in the number of oil and gas rigs working since the start of the year. So in numbers, producing U.S. oil, rigs in March 2020 were around 68. At the same time, refiners and gas distributors faced their own crisis. Lower oil prices didn't necessarily mean cheaper gas. That's because they were also scrambling to find new sources of crude oil amid the tax-driven reshuffling. In some cases, refiners had to pay more for different oil blends, and they passed those costs down to consumers. For American families, it meant higher gas prices even as oil prices dropped. A confusing and frustrating contradiction that made headlines. Traders didn't help calm the storm either. Panic set in on Wall Street, and energy stocks took a nosedive. Investors pulled out of oil-heavy portfolios, fearing a long slump. What they saw wasn't just a price dip. It was a breakdown in confidence. The volatility hinted at something deeper, an industry that could no longer predict what tomorrow would bring. With the political landscape shifting and no clear end in sight, everyone in the energy market started preparing for more pain. U.S. President Donald Trump has announced a new set of taxes, an additional 25% on any country that imports oil from Venezuela. This is over 1 week after the oil market went into a tailspin. The White House hit pause, but only halfway. On April 9, 2025, President Trump made a new announcement that temporarily calmed tensions. He gave a 90-day break from the Venezuelan oil taxes to every country except China. It was a sudden change that aimed to calm markets, reassure allies, and avoid a full-on global oil crisis. The message was mixed. The U.S. was still tough on China, but it was throwing a lifeline to everyone else. Traders were quick to respond. Brent crude prices climbed above $65 per barrel, and West Texas Intermediate bounced back, landing around $62.35. It wasn't a full recovery, but it was enough to stop the bleeding for the moment. The move had a calming effect, but not because the basics had changed. It was purely based on what people thought. That small policy change was all it took for the market to gain a little ground back. It proved just how reactive and fragile global oil pricing had become. Every word, every press conference, every signal from Washington could make billions of dollars shift in a single afternoon. The fact that prices bounced back so quickly told everyone one thing. This wasn't a supply and demand issue. It was a policy-caused panic. In Trump's tax wars after his administration will not likely meet Wednesday's deadline to secure 90 deals in 90 days. For us producers, it was a breath of relief. Some companies used the bounce back to lock in slightly higher prices through short-term contracts and hedging tools. Others scaled back the damage by pausing layoffs or pushing ahead on limited production. But even with this recovery, there was no celebration. Oil executives knew the 90-day pause was exactly that, temporary. With China still under the full weight of the taxes, and no guarantee the pause would extend beyond summer, everyone stayed cautious. No one was going to gamble on long-term drilling just because the market had stabilized for a few days. What made things even more complicated was how uneven the break was. By leaving out China, the world's second-largest economy and a top energy consumer, the administration sent mixed signals to the rest of the world. Some countries felt lucky to be spared. Others worried they could be next. And China, as expected, hit back with revenge taxes of its own.